Welcome. Many thanks for joining us today for one of our regular On Top of Tax events designed to keep you up to date with hot topics in the tax world. I'm Neil Brackstone, tax partner in the Reading office, and it's great that you've been able to join us today. And I know myself and the other presenters are looking forward to sharing our thoughts and experiences with you. So back in the days gone by, I would now start to talk about fire exits and logistics. However, now as many of us are working from home, it's probably more appropriate to make sure that you have a drink, cup of tea, somewhere comfortable to sit back and listen. So in terms of the agenda today, I'm going to start by just spending a few minutes to share some results from the latest BDO Rethink survey, which I hope you find interesting. This is going to be followed by Glyn Woodhouse talking to you about the latest developments and thoughts on Brexit as we rapidly approach the end of the transition period and as negotiations between the UK and the EU intensify. Mark Seaton is then going to talk about CGRS and the taxation of termination payments and some other related topics that hopefully you'll find useful and informative. We then have a special guest, Russell Dan from Clark's Legal, who's going to provide some legal thoughts on some of the points that Mark is covering. So we welcome questions as we go along by using the question and answer function, which I think if you hover on the screen should come through at the bottom of your screen. So click on the icon and submit your question. So we'll take some of the questions at the end of each of the presentations, but we'll also pick up at the very end any other sort of remaining questions as well. For your information, we're recording this webinar so you can review it later when you're using the question and answers, and also we're going to run a short poll during the presentation. There's an option to remain anonymous when participating, so I thought I'd mention that so you can take that into account when you're using those functions. Okay, right, okay. So I'd like to start by explaining what I mean by rethink. So this is a framework we're using in conversations with businesses to help them undertake a broad reassessment of their original business models and assumptions as they respond to the pandemic and look to grow in the future. Now, we're all aware of the effects to one degree or another of the pandemic on organisations, businesses, their employees, the economy as a whole. And this is forcing change, whether it's economic, societal, and or commercial. Now, this framework is to sort of help those considerations and thought processes and breaks down into sort of three key stages. So the first stage is the react stage, which for many of us is what we were doing back in the spring when we all had to deal with the emergency and sort of work out how we safeguard and operated our businesses. The second stage, which I think many of us are in at the moment, is looking at how do we keep our business running when we've got lockdown and these social distancing rules, and how do we keep changing to the changing position. But we're also starting to see businesses and others start to think about this third stage, which is about how we respond to the new normal in whatever form that may take. This could include new business models, different ways of working, understanding the political, economic and technological changes that are going to shape the world we operate in and live in now and in the long term. And under each of these headings would be various topics to consider. Now, there's far more to say about this framework and the approach, and I'd be very happy to discuss this separately with you, but because the focus today is very much on tax. As part of the Rethink framework, we undertake a monthly survey of businesses across the country, and what I want to do now is just highlight some of the recent results. I think you might find some of those interesting. So it's a series of 15 questions which we ask businesses, and through the answers we're able to identify some regional variations as well. And what I'll point out though, this survey results we got were completed between sort of 15th and 21st of October, so it was before the announcement of the second lockdown. So the first question I wanted to mention was about whether businesses are more optimistic about the economic recovery than they were 3 months ago. As you can see, the Thames Valley appears to be more optimistic than the overall national picture. And to some degree, I would really sort of anticipate that, partly in due to the fact that we don't have the same level of, well, at that point we didn't have the same levels of restrictions as other parts of the country. but also because we probably have a greater prevalence of technology and life science companies in the local economy, and they make up a greater proportion of the economy, and also they've probably weathered the pandemic better than sort of other sectors. What I think would be quite useful to do, and what I'd like to do, is just quickly rerun that poll with the audience today. So I think what should come up now on screen is the poll. So be very grateful if you could just just quickly go in and just click through what your initial view is from your perspective to that question. We'll sort of give it sort of 30 seconds or so just to give everybody a chance to consider, and we'll then just quickly share the results. Okay, right. So we've got the results in. 45% of you are more optimistic, 19% are less optimistic, and about 35% are feeling the same. So just subtle differences on what we had earlier. And as I say, obviously, as the changes happen, and obviously we got the announcement of the potential vaccine, and obviously the lockdown, that there's going to be fluctuation in our outlook in the future. Right, so just moving on to thanks. So thank you very much for that. So in terms of the next question that we had, okay. So on that one, what we were looking there was also looking forward to 2021, and what were the biggest threats that business saw to their businesses. And again, as you can see, the Thames Valley tracks the national picture, with the impacts from COVID-related threats cumulatively being the biggest, with Brexit being one of the minority ones there. What we then did is we also then took one of those particular questions, which was looking at the threat to businesses of having to pay back the loans, etc., that have been taken out during the pandemic. And what we can see there is that the sort of Thames Valley position generally follows what the national picture was. Although there was a minority saying that they would never be able to pay back, which is interesting and does support a view that some businesses have balance sheets that will ultimately need to be restructured in order for them to grow and survive in the future. We then asked a question about whether the pandemic impacted on businesses' plans to expand overseas, and the Thames Valley did stand out, with a majority saying no, because they never had plans to. And I think that may well be because many of the businesses in the Thames Valley already have an international dimension to them. The final question I want to highlight and just sort of share with you today, and this is a segue into our next speaker, is about readiness for Brexit. And what this appears to show was that the Thames Valley has more businesses with plans than the national position. And obviously time will tell if those plans were the right ones. Now, before I hand over to Glyn to discuss Brexit and what those plans should be considering, I just wanted to check if there were any questions. Okay, well, I don't seem to see any questions coming through at this stage. But as I said earlier, feel free to add questions. We'll be monitoring them as we go through, and we'll pick them up at the end of each of the presentations if we can, and other ones at the very end of the presentation as well. So thank you. At that point, I'd like to hand over to Glyn Woodhouse, who's going to take you through some thoughts around Brexit.
Thank you, Neil. And it's great to talk to you all. Delighted to see that stat that 78% of people actually believe that they're ready for Brexit. That's really, really good news and is quite a long way above the national average. Now, hopefully I can move on with the slide. There we go. I'm going to have to talk quite quickly here because there's an awful lot of stuff to go through for people, because we'll have people who are quite detailed plans and we'll have people who are quite new to the Brexit planning. I'm going to try and run through how the changes look for different types of businesses, some of the solutions out there and some of the stuff that's come out in the last week or two, and hopefully that will be of interest to people. I haven't got an enormous amount of time to do it. If you want to see a more detailed conversation about it and you want to see a more detailed presentation involving the customs duty, etc., one is going to be released at the beginning of December, and I have a slightly older one that we did a couple of weeks ago if you want to see a copy of that. So the UK left the EU with effect from January 2019. And we have a transition deal which runs out at 11 o'clock on 31st of December this year. And that means effectively that from the 1st of January, everybody's going to have to trade under new conditions. That's only 50 days away. So if you've not looked at it, now is really the last time that we're able to do so. What's going to be different? Well, there's going to be no more intra-EU movement. Everything's going to be formal imports and exports. What that means is that customs declarations will be required for both imports and exports. Import VAT is going to switch to the VAT return. That's both imports from the European Union and external, unless you don't want it to happen, in which case you can pay it through your deferment account or your freight forwarder. Why you would want to do that is a bit of a mystery to me, but it is optional. Because it's optional, that does mean that you need to tell your freight forwarder what you're going to do. So if you want to account for the VAT and get the cash flow benefit of doing it on your VAT return, you need to tell your freight forwarder to tick the right box when they make the import declaration. Customs duties might apply. They can be paid either through your deferment account or your freight forwarder. That's all movements into the UK and out of the UK, and every time they do so. There is a free trade agreement being negotiated. The outcome is uncertain. Most commentators estimate that a comprehensive free trade agreement is less than a 5-to-1 shot. I'm not sure I agree with that, and I could talk all day for the reasons why. I think that there is a possibility of a temporary free trade agreement that will remove customs tariffs, but I can't promise that, and we're really not sure about that. So let's talk about the different types of businesses and how they're going to be treated post-Brexit. So if we look at business-to-business supplies of goods, first of all, and many of you will have seen these slides before, so I'm not going to spend a lot of time on them. But the real VAT impact comes when you import goods. So if you import goods into another EU member state and then sell those goods, you are likely to have to register for VAT there. You're going to have to pay the import VAT, and the only way you're going to get that import VAT back is by registering. You may also pay import duty at that point. Businesses that are not established in the UK that are bringing goods into the UK and then selling them will also have to register for VAT here. The key is, who is the importer? So if your customer is importing the goods, you don't need to worry. If you are importing the goods, then you do. So you need to look at your Inco terms and make sure that we've got those right. All of the EU simplifications will fall away for UK businesses because we're no longer part of the European Union. And that means that if you have call-off stock, so that's stock sitting in a customer premises overseas, and you're ignoring the VAT registration requirement of the call-off stock rules, as in they're drawing down the stock and we treat it as a movement on day one, that will go away and you will be obliged to register wherever you have stock. Supply and install. So if you're supplying goods which are installed into a customer premises and ownership passes while it's in the customer premises, that may also give you a VAT registration, depending on the country that it's in. Triangulation. Triangulation is just, it always sounds very complicated, and it always comes with this wonderful diagram, but all that means that if you are the intermediary, so you are buying goods in country A, say France, and arranging for those goods to be delivered to your customer in country B, say Germany, you are going to have to register for VAT in France or Germany. Other VAT registration issues. So, as I mentioned, check your Inco terms. they're the things that will drive whether you have a VAT registration requirement. If you have an overseas VAT registration, just check that it doesn't need to be changed to a non-EU VAT registration. A couple of them are slightly different in different member states. And if you are saying that your customer is going to import the goods, make sure they know they're going to be importing the goods. You don't really want to start having rows with your customers 1st of January because you can't get the goods to them. Going to quickly talk about business to consumer now. This is rather more complicated and has become quite a lot more complicated post-COVID. There was a business facilitation measure that was designed to take a lot of this pain away, that was due to come in from the 1st of January. That's now been punted back to July. And Germany has applied to have it go back again. It's been turned down for the moment, but you know, it may be a little while yet. So what does that mean for us? So at the moment, pre-Brexit, so if you have goods being sold from a UK retailer to private individuals in the European Union, they charge UK VAT until it reaches a threshold known as the distance selling threshold. Then you're obliged to register for VAT there. It's as simple as that. Nothing else really happens there. So post-Brexit, you need to make a decision whether you are going to import the goods and take the pain away from your customers, or your customer is going to import the goods. If your customer is going to import the goods, any VAT and duty on those sales of goods, your customer will need to pay. This, in practical terms, means that the local post office will bang on their door and they won't release the goods until they've paid the VAT and the duty plus an admin fee. Obviously, that can cause a bit of friction with your customer base, and most businesses are trying to avoid that. There are freight forwarders out there who will arrange to pay the customs VAT and duty as part of the process, and some of those are quite good, but of course there's a cost to accessing those arrangements. And that's pretty much all you can do until July. If you are going to be the importer of record until July, you are going to have to register for VAT in every member state you have a customer. So if you have a customer in Germany and you are importing goods in Germany and selling those goods as a retailer in Germany, you will have to register for VAT in Germany. If you have customers in all 27 member states, you're going to end up with 27 member state registrations. Many people are looking at having distribution centres set up, often in the Netherlands or Belgium, and then distributing the UK stuff through there, but it's important to get onto that early. So after July, everything gets a little bit different. The trade facilitation measure that I mentioned earlier, known as the Import One-Stop Shop, which is distinct from the Mini One-Stop Shop EU and the Mini One-Stop Shop non-EU, and this applies to low-value goods less than 150 euro. So if you sell goods B2C, normally it would be less than 150 euro. That means that you can register once in Europe, account for all the VAT, and then you can just send it to your customer. But that only applies until after July, and we haven't seen the details of exactly how you apply for it and where you have to apply for it, etc., etc. But it's going to be very, very useful, but it's only available from July. And as I mentioned before, Germany has applied to put it back to COVID, and it's possible that it may go back, but I don't think it will now. Services. Now, we've taken a kind of broad view in the profession that services are going to be broadly unchanged, and this is true, but there are some services which are slightly different. So the impact is much less than goods, but we still need to think about it, and our VAT, our obligations around VAT reporting are going to be subtly different. So we need to make sure that we got our systems up and running and that we're okay. It's a little bit easier with services, but we need to do that nonetheless. So what does that mean? So most business services remain the same. There's very little differentiation. Some of the reporting requirements are slightly different, but that's all. We need to be careful where we have use and enjoyment provisions. Use and enjoyment provisions move the place of supply from the place of supply of your customer to wherever they're used and enjoyed. And basically, it's to stop people selling goods, selling services. So often big contracts with say Switzerland, and then having those goods used and enjoyed in the EU. Because that's an EU, non-EU definition, that is going to change. The financial services, people among you, the specified services order means that you can recover VAT on goods, on certain financial relating to certain financial transactions taking place outside the European Union. So if you have sales of shares on the New York Stock Exchange, for example, you have a right to deduct input tax on associated inputs in the UK. That has now been extended to anywhere outside the UK, so all of the European Union trades will be done in the same, and that's now been confirmed by the government, and the legislation has been prepared. Tour operators, unfortunately, we still don't have the detail on what the new tour operator looks like. Most tour operators operate under a thing called the Tour Operators Margin Scheme. It's quite complicated, and there is a big differentiation between EU and non-EU. Currently, there is very little guidance on it. So if you're in that position, talk to your advisors. So what do you do? Well, I think the most important thing is that you need to get an immediate plan. Make sure that you have a UK EORI number in case you need to import goods from the EU or from anywhere else for that matter. Map out your supply chains, check your Incoterms, make sure that everything is going to run smoothly from the 1st of January. Check that you and your shippers know what you're doing. I know it sounds silly, but you know, if you don't tell them, they won't know. Who is going to be the importer? Who is going to be the exporter? And there's a customs establishment criteria, which I'll mention in just a moment. Make sure you know how you're going to make your import and export declarations, whether you're going to use the deferred declaration system that's out there, whether you're able to use it, and if you are, how you're going to actually do that. Remembering that if you have to pay customs duty, you do need to have access to CFSP. Do you need to upskill your staff? There is still a little bit of grant left for customs training for your staff. If you think that you're going to be in a position where you may have to do import and export declarations yourselves in the future, or you want the option to do so, or you have an intention to do so, do let us know, because we can arrange for you to apply for that grant and get free training. And don't forget the mundane. And by that, I mean, have a look at your VAT accounting. Think about your export evidence. When you have imports, exports of goods from the UK, you need formal export evidence. That's a bill of lading, airway bill, that kind of thing, as opposed to just commercial evidence. This is really, really important. And every year, the revenue have a purge on evidence, and we're left arguing with the revenue and trying to piece together evidence that we should really hold. They know it's an easy area, and I'm hand on heart, I know every year at least 2 of my clients are going to fall foul of this, so be wary of that. You're still going to need to do Intrastat for arrivals. Intrastat fans will be pleased to know, even though we've left the EU, although you won't have to do EC sales lists unless you're in Northern Ireland. So what's the latest? Well, I mentioned Northern Ireland there. The Revenue have now produced a business brief to explain kind of what's going to happen in Northern Ireland post-Brexit. This is a little bit departing from normal VAT rules. So VAT geeks are going to probably end up with a headache when I run through this. But sale of goods from GB to Northern Ireland will be treated with UK VAT in the normal way. Okay. If you move your own goods from GB to Northern Ireland, you will have a requirement to account for VAT on that movement. Now, normally that will just be an in and an out on your VAT return, so it will generally be recoverable. If you're unable to recover the VAT on that, then you can readjust the initial input VAT recovery so that it makes sense. So if you're able to recover 50% of VAT, you can move your goods over to Northern Ireland. You'll have to account for VAT on the value of those goods and recover 50% of it, but you won't get a double hit because you can readjust the original input tax recovery to balance it, if that makes any sense to anybody whatsoever. If you move your own goods into a VAT group, normally that would be ignored. So if I sell from company A in the VAT group to my Northern Ireland company in my VAT group, that movement will be treated in exactly the same way as a movement of own goods. So VAT is going to be chargeable. There may be some intra-EU simplifications available for goods that only involve Northern Ireland but don't involve the rest of GB. And I've not got a huge amount of detail there, but they'll be interesting. People who sell under the margin scheme, there are some quite significant changes, and you're probably going to have a look at those changes and see how they're going to impact you. Generally, they're not going to be positive, I think. So we move slightly onto the customs requirements for moving goods from GB to Northern Ireland. There's going to be a differentiation between goods which are deemed to be at risk. So at risk means at risk of moving into the European Union, it's normally into the Republic of Ireland. And those at-risk goods may have duty on them. You will also have to do some kind of accounting for moving the goods from the UK to Northern Ireland. They have a free service called the Trader Support Service. And if you have any business in Northern Ireland, I would recommend that you sign up for that as soon as you can. If you sign up by the 21st of this month, you will get automatically a Northern Ireland EORI number, an XI EORI number. And that might be quite valuable quite soon if you have Northern Ireland business. Unfortunately, the government hasn't quite released any great detail on what happens when I sell goods from Northern Ireland into Republic of Ireland, but I'm sure that'll be incoming shortly. One final issue, because I'm just about to go out of time, and Mark Seaton is going to get very cross with me. I just wanted to mention there is a problem with establishment in the European Union. The Union Customs Code, which is a code which covers all customs issues in the entirety of the European Union, says that you have to be established in the European Union in order to make imports into the European Union and to make export declarations out of the European Union. And that's quite a big issue because establishment means the same as it does for VAT. So it's human and technical resources required to do the supply. And that's quite a high bar. Unfortunately, if you're not, then your customs agent needs to be what's known as an indirect agent, which means they're jointly and severally liable with you. Historically, most member states have ignored this requirement, or freight forwarders have tried to avoid becoming an indirect agent by subtly changing the import declaration so they're not quite right, but nobody really cares. We are aware that there are a number of member states that are now seeking to apply these rules. So thinking particularly the Netherlands have mentioned that they will, as will Ireland. I think France is a little bit more nuanced. So it's really, really important to keep an eye on that because that may change and you may end up with a requirement to be established. So I think that's all from me. As I mentioned, there are other stuff coming in for VAT and customs declarations and Brexit. So let us know if you want to be involved with that and we'll make sure you get that. So without any further ado, an apology for Mark for taking 2 minutes of his time. I'm going to hand over and thank you very much for listening. Cheers. Good luck, Mark.
Thanks very much indeed, Glyn. And as if I would ever get cross with you. Of course not. Thank you everybody for attending. Myself and Russell Dan are going to be talking around some of the issues that we're facing at the moment around the CJRS, the issues around working from home and questions that are coming up there, and also on termination payments. So there will be a little swap between us once or twice, but that's going to be the focus. On the CJRS, I am not going to be talking about how to make claims. I would need probably the rest of today to go through that, but rather what are the revenue doing now in connection with CJRS claims that have been submitted. So, as I say, let's start off with HMRC reviews and some of the common errors that we're finding around the CJRS. Hopefully what this table shows is probably something that anybody who's submitted a claim knows full well, that we have had half a dozen variations at least on schemes, and we're just entering into a new one. Everything from 80% of pay being covered and employer NIC, and employer pension contributions, gradually whittling away down at that, but bringing in flexibility around the scheme, and now going back to the 80% again, but without the employer nick. It's a minefield. There's so many variations. Keeping on top of it has been incredibly difficult. We've had weekly guidance from the revenue as well, saying how to do claims this week compared to last week. So hugely complex. And as a result of that, the revenue are recognising that there have been a number, that it's likely that there's been a number of errors. So that's some of the errors that we're seeing when we're helping clients with the claims or looking at some of the claims that they've made. What I'm going to do in a moment is just go through 3 of the most common errors and just sort of show you the impact that they have. What I would say as an overall comment is make sure you document everything you do. The revenue are going to start reviewing claims. They've already started that, and being able to evidence the reason behind what you did will help you if you have made a mistake in connection with assessments and penalties. So let's look at 3 examples. Names have been changed to protect the innocent, or not quite so innocent, but all of these are real examples. Dates have changed and things like that, but they're real examples. So Aaron was employed on 12th of February, but missed the first payroll. He joined the company in the middle of February. His first RTI payroll run was in March, at the end of March with the normal pay. The problem here is you have to have been on the payroll basically at the end of February for most people. You have to have had an RTI submission prior to 19th of March. If you weren't, the revenue don't care about what was fair, etc., etc. Sorry, you were not on the RTI submission. Therefore, you are not an eligible employee, and there is no flexibility around making a claim. There are a couple of exceptions to that around 2P transfers, for example. But if you've taken on a new employee, you can't claim anything. If you have claimed for somebody who wasn't on the payroll at 19th of March, then that claim is invalid. Second example, Jenny was employed 1st of January, so well before the cut-off point. She was postponed on her auto-enrolment into pensions, and in April she joined the pension scheme, but under a salary sacrifice. When we've been looking at the claim, what figures do we use? We use the reference pay at 28th of February, which was before she entered the salary sacrifice. The fact that her pay reduced is irrelevant. We use that 28th of February pay. It does that if you are only paying the statutory amounts, the 80%, and there is no scope for a salary sacrifice, you can't do that. You have to pay the minimum 80% of reference pay. If you don't pay that 80%, then again, your claim is invalid, even if you're only claiming the amount you've paid. So salary sacrifice and other adjustments to pay, be careful when it comes to the claim. Steve was furloughed on the 1st of April. On the 10th, he undertook some training, and on the 17th, he attended the office to fix a significant IT issue. The training is likely to be okay from the furlough period, but the 17th of April means that you have breached the 3-week period. You haven't been furloughed for 3 weeks. It was only 16 days in this case, 1st to 16th of April. And therefore that one day coming in the office to fix it means that you cannot claim anything in connection with Steve unless he is furloughed for 3 weeks from the 18th of April onwards, in which case you can claim from that period onwards. So these are 3 common errors. Were you on the payroll? What is your reference pay? How does salary sacrifice interact? And did you get furloughed in that initial period of furlough for a minimum of 3 weeks? Any failure on those would make those individual claims invalid. So if when you go through you find that you've got an error, what should you do? The very early ones were more around fraud. And arrests were made in July around fraudulent claims, and I expect that will continue. But they are using the information that they've got to carry out reviews into CJRS claims. For example, when you've made your claim, you've identified the employees that you're claiming for, the national insurance numbers. They are able very quickly to check their pay records to see was that individual on an RTI submission beforehand. So I think there is a strong chance that you will get a review if you have included people that you shouldn't, for example. They'll then move on to ones where it requires a bit more work and go through those. The revenue have indicated a bit of a two-tier approach. So if you find you've made a mistake and you go to the revenue and say, I've made a mistake, it is likely that the penalty regime will be a lot softer than if you wait for the revenue to find the mistake for you, so to speak. There was a date of 20th of October to make adjustments to totally avoid penalties. I would say as well, you've got until the 30th of November to correct anything that was from previous claims. You can correct those and those. But even if we miss that date, let's find the problem as soon as possible and correct that. My recommendation therefore, NHRS, is perhaps carry out an internal review of the approach you've taken, from eligibility of the employer to employee, to the data roles, from payroll into the CJRS claim. Sense check those calculations, do they look right? And perhaps get an external assessment of any risk. BDO has got a risk assessment tool. We can take, you can complete a questionnaire effectively, and from that we produce a report that says this area is robust. It sounds as though you've got very good processes. This area, however, may require a bit more focus. If you'd like to talk about that, please do contact me afterwards. Working from home. First thing to say, that is not a selfie, I must say. That person is quite relaxed from the trousers down. I'm going to talk very briefly about equipment, running costs, and some of the travel and subsistence rules. There's been a number of guidance statements from the revenue around equipment, because obviously a lot of businesses have provided office furniture for people in their home under lockdown, and commented on the type of that. Generally speaking, if you're providing equipment to the employee that will at some point be returned to the employer if they no longer work from home, then there will be no tax liability for that. There's an interesting anomaly, in my opinion. If the employee purchases the item up front, so I purchase a desk, submit an expense claim and have that refunded, then the revenue will not assess a tax charge on the fact that the equipment is never returned to my employer. This being on the basis that it was always my desk because I purchased it in the first point. The thing there, just to make sure, is that when you do reimburse it, you don't say to your employees, okay, that desk is now ours, because at that point it means the ownership has transferred to the business, but a strange one. Expenses for working from home. You may have seen a lot around the £6 per day, sorry, £6 a week allowance for working from home. Initially, this was set up as something that the employer could pay, but the employee couldn't claim tax relief on unless they could identify actual costs incurred. This guidance then changed, and indeed now the revenue have opened up a portal so that employees can go on and claim tax relief in case this is working the £6 a week allowance. It does say that you can claim the tax relief if you have to work at home on a regular basis. However, you may be aware that Martin Lewis asked a few questions, and the revenue have confirmed that if you have to work from home on one day, then you can claim the tax relief for the whole year. Bit of a strange one, but that is the way they set it up, just to make it easy. The one thing I'd just say be careful about on that is, if you decide at some point in the year to reimburse the £6 a week, that you decide to meet those costs, then make sure that the employees haven't claimed tax relief as well, because you'd end up with a double catch on that. Home broadband costs can't be reimbursed unless you can show that you've incurred an additional cost because of working from home. Most of us had broadband before COVID. Most of us probably had that on an unlimited or uncapped data package, so it would be difficult to argue additional costs. Travel and subsistence rules. We sometimes get asked, will this mean that in the future, if I'm working from home predominantly, I can claim for going into the office because that's no longer my permanent workplace. I think this will take an hour-long session on its own. You're going to have to be very, very careful before you try to argue that the old office is no longer a permanent workplace. For one point, you're going to have to show that over any 2-year period that you're currently in, you haven't spent 20 to 40% of your time there, depending on the actual arrangements. So reimburse those costs with caution is what I would say, and seek specific advice. At that point, I think I'm going to be handing over to Russell to talk about the connected to working from home. So Russell, I'll hand over to you.
Thanks, Mark. I hope you can hear me, and hopefully in a moment you'll be able to see me as well. So if we're talking about working from home, there's a few more elements to this that people probably didn't think about when we started in the beginning of the pandemic, but in essence, people have been working from home since March. We would now say that is permanent. As far as assessments need to go, although I agree with Mark, it isn't permanent in any other sense. There are obligations. There are obligations to make sure that people's workplace is as safe as far as is reasonably practicable. And then if someone is working from home, there is a need to carry out risk assessments. Those risk assessments need to be either temporary or permanent. These health and safety obligations do include mental health. And what I'm going to talk about is not only the need to do risk assessments, but also what we should be doing to look after people's health anyway in this circumstance, because we know that people weren't intending on a large part to work from home as much as they have done, or they've had other family members having to do the same thing and the setups aren't there. So as well as the ticking the boxes, it's a matter of finding ways to keep in touch with your people and have systems in place so they can keep in touch with you. Businesses really do need to look at the HSE guidance, the ACAS guidance, and having a way of actively monitoring to check people's mental health. This doesn't mean checking up on people in a sinister way, but having a way that you can check in with them and see how they're doing is extremely important. There needs to be a particular focus on the DSC, the display screen, and related matters. There's a specific assessment that needs to be done, so it's a matter of, in the risk assessment, building in that home working is something which you need to get the people to say, what is your workplace like at home? All of this is important to make sure people do work effectively, to make sure they are working in a safe way, in a way that's sustainable, but also protectively. If you haven't done any of these things, then, or haven't done them properly, then you're much more likely to be liable as an employer for claims for injury. If someone's been sat hunched over a laptop on their bed for months on end, or if someone has been left isolated in a way that isn't suitable and has become unwell with mental health problems, then that could lead to claims against you. But okay, that comes after the need to look after the people in the first place. The risk assessment doesn't have anything specific on equipment and lighting, and there's no obligation to provide equipment, but it should be part of good practice to build that in. For permanent working from home, and by permanent here we just mean long term, so again, since March would count as permanent for this purpose, the risk assessment needs to include an ability to report accidents. So the employees need to know how to report accidents. All of this is because the home becomes the workplace. So it's the Health and Safety at Work Act, but the home has become the workplace. First aid, again, in the risk assessment, making sure that people have access to normally domestic first aid kit is perfectly acceptable. It's not the case that most people working from home will be undertaking physically dangerous roles. So moving on to termination payments. Before we get to termination payments, we obviously need to talk about the interaction with the extension of the job retention scheme. So there can be a question of whether someone is going to be placed onto the furlough scheme or not. If there's a selection, it needs to be fair. There won't always be a selection. If it's an entire office, an entire workplace, or an entire role across multiple workplaces, then you're not picking who's going to be furloughed, who's not. But in some cases, it will be a diminution of work, rather and some people being furloughed, some not. In any case like that, it's crucial there's no discrimination. It can be particularly the case that you have people sometimes with the best of intentions making decisions which discriminate against disabled or pregnant colleagues on maternity leave, and indirect sex discrimination to those with caring responsibilities. Not always with the best of intentions, sometimes not, but it's important to scrupulously check that the way this is being decided doesn't have any element that could be discriminatory. It's also important, perhaps counterintuitively, not to use redundancy criteria, but you don't want the people who are being selected for furlough to think that the reason they're being selected for furlough is because they're being pre-selected for redundancy. One thing we've seen that works with a lot of clients is seeking of volunteers. So if you've got a reduction in the amount of people you have work for due to the downturn, then you can look at who chooses out of those affected employees who wishes to be placed on furlough. That can help with people who have caring responsibilities. That can help with people who have who themselves have health conditions that either they're concerned about but don't fall into a protected category, or they are in one of the categories designated as clinically extremely vulnerable, or someone in the household is. That can really help. If you don't get the number of volunteers you need, you do need to still have a way of choosing between them. And our advice is it is okay to prioritise those who do meet those definitions, in particular those who have volunteered not to be placed on furlough because of caring responsibilities, or because they are or live with people who are clinically extremely vulnerable. Otherwise, a random rather than performance-based selection, because if you don't do that, you tend to get into a situation where it's effectively like a redundancy. The point is, you can't impose furlough on people. They may decline to be furloughed. You have to consult and agree, as I think everybody knows. If employees don't agree, the alternative will usually mean termination of employment. That isn't necessarily going to be redundancy. If you were telling your particular section of workforce that there was a reduction, so people's hours are going to reduce. Let's say nobody was going to be on full-time furlough, people were going to reduce from 5 days a week to 4 days a week, something like that. Then if someone declined to do that, then that may not be a redundancy, because the reduction of the work that's required, but not a reduction of the number of employees who are required to do the work. But in many cases, it will be a redundancy. If it's not a redundancy, the termination doesn't necessarily attract redundancy payment. But what I'm going to say about redundancy, it probably all still applies anyway. From the employer's perspective, employers may decide that they're not going to use the extended scheme, or to use it only for a short period. When it was announced, this extension last week, it very much looked like, well, we've got 6 months of extension, and the first 3 months are stable in terms of what businesses have to contribute, meaning if someone is on furlough pay, businesses are only contributing the employer's national insurance contributions and pension contributions, and then for that to be reviewed in January. However, as the announcement didn't say, but the guidance yesterday that was published did say, the notice period for someone on notice of redundancy or termination of employment from 1st of December, you may not be able to claim a CGRS grant for that. So that means that many businesses will be looking at, well, this does take us forward compared to where we were. We've got a potential 1 month of CGRS pay rather than what was going to be 1 month of the job support scheme pay. But after that, well, we'll be back in the same position. If someone's going to be made redundant or otherwise terminated on notice, then we're going to have to pay the full amount without any of it being claimed back through the CGRS system. So lots of businesses will be looking at termination of employment. And again, probably from 1st of February next year, it looks like employers will have to start contributing. We can imagine it'll be a little bit like September and October in 2020, of course, remains to be confirmed. if there is going to be a termination of employment, firstly, making sure there's no breaches of contract, checking payment in lieu of notice in particular. Not all contracts allow it. It may suit both parties, but if you terminate someone and in lieu of notice with payment, you have lost the benefit, if that's not in their contract, of things like non-competition or confidentiality clauses that would otherwise or could otherwise have survived the termination of the contract. And then if it is a 20 or more people or 20 or more jobs at one establishment which would be terminated, then you've got collective consultation obligations. I'm not going to use your time today to go through what they are, but they must be done. It's very expensive if you get them wrong. It involves notification to the Secretary of State, and also it involves mandatory consultation with employee representatives. The penalty is, by the way, 90 days actual pay per employee maximum for getting it wrong. Whether or not there are 20 or more, there's also individual consultation which you need to do, and that individual consultation does need to be done in a fair and proper way. It's not acceptable to simply use the person has been furloughed, or to use that at all as a selection criteria, again for the obvious reason. So with that, I will pass back over to Mark, who is going to take you through some of the tax side of termination payments.
Thank you very much, Russell. Yeah, so indeed very complicated on the legal side as well as the tax. I'm just going to run through a couple of areas relating to the tax side on termination payments, hopefully quite quickly. So in the old days, whether a payment in lieu of notice was taxable, I would always have argued depended on the contract. Was it provided for in the contract or the handbook? The revenue didn't like that. And what they've done a couple of years ago is legislate to make a payment connected to the unworked notice period always taxable. There's a lovely bit of algebra on the screen there and some definition of the letters, but it's how to calculate the taxable sum in the event of a termination where notice hasn't been worked. We'll go through going through show change. These thing is the basic pay, the pay that you use to calculate the payment is based on your pay before any salary sacrifice, and it excludes some allowances. Car allowance, for example, may or may not be included in the calculation for PENP, depending on the exact circumstances. So it's quite complicated. Quick example, an employee is earning £60,000 a year, so £5,000 a month, but sacrifices 10% into a pension scheme to make sure, obviously, of the national insurance savings. They're entitled to 3 months' notice. On termination, the employee works none of their notice period, pays a payment in lieu of notice of £13,500. So that is exactly what they would have got if they'd worked their notice, plus some redundancy pay, magically works out exactly 10,000, an ex gratia payment, and employer pension contribution. The anomaly comes in here. So that's exactly what they would have got if they'd worked their notice period. But because of the way PENP works, it works on 60,000 as the salary, not the post-sacrifice pay. So actually, there is an additional £1,500 that is taxable over and above the 13,500. So had they worked their notice, 13,500 would have been taxed. Because they didn't work their notice, 15,000 is taxed. So you do need to be careful with your PENP calculations. Another change relates to national insurance. In the past, payments over 30 redundancy payments, sort of thing, were not liable to national insurance. The excess was taxable but not nickable. We now have a Class 1A national insurance charge for those payments. That's from 6th of April this year. So if you're paying more than 30,000, that is taxable under Section 401, the 30K type payment, it will be liable to Class 1A national insurance through RTI. Finally, just a reminder, this isn't anything new, but if you've got a termination payment, the package exceeds 30,000 and it includes non-cash items, then there is an obligation to report to HMRC. If you pay just cash and it's over 30, you just have to do your withholding as you're required. But as an example there, if you've got 28, some non-cash items, benefits, perhaps not an employer pension contribution, but a medical benefit, you would have to report that to HMRC. I think that is the end of my slides. Oh, sorry. Yes. So any questions at this point as I hand back to Neil?
Thank you, Mark. So yeah, just before I summarise what we've just heard, and I just want to say if there's any additional questions that people want to ask the speakers, please submit them. We'll look at those in a minute. Just turning to what we've heard, there's been some interesting points I think raised this morning. I think looking and listening to Glyn, obviously there's a number of things we need to think about. Seems to be some added complexity around the admin processes around both VAT and customs duties post-Brexit. Obviously, despite the transition period ending shortly, there's a number of uncertainties out there, so we're going to need to watch this space carefully. You know, turning to Mark and Russell, they highlighted the complexities related to CGRS and the minefield that many businesses have had to navigate and will continue to need to navigate over the forthcoming months. Hopefully, some of Mark's comments and along with Russell's has helped. As we all work from home, there are both tax and legal considerations, and if the trend for more home working continues in the long term, which I think is in many cases the expectation, we're going to have to think about these more than we did before. Again, whether we do see some updating of the guidance and legislation in the forthcoming years around that. In the unfortunate case, we're going to have to let employees make them redundant. Then obviously there's some things to certainly think about there. So just in terms of the questions. Okay, Mark, I think Mark and Russell, this might be one for you, and it may be one you want to take offline as well, but just to read that out, if we terminate an employee's contract, they've worked less than 2 years, and we pay 2 months on top of a month's notice, does the 2 months become exempt for NI, as we could class as a redundancy?
Thank you, Neil. Yeah, so from the tax and NI perspective, you'd first work out, so on top of a month's notice. So if the individual was only entitled to 1 month's notice, then you'd work out your PENP calculation based on the notice they're entitled to. Whether your month's notice exceeds not, you as a PENP calculation. Assuming that doesn't apply, we terminated it. Apologies, it does keep saying that I'm unstable internet, so hopefully this is coming through. I think we need to have a sort of wider discussion, because it could be, if it's redundancy, then that could be okay, but we could also have some awful treatment under an employer-funded retirement benefit scheme if the employee was senior in years, shall we say. So complicated, potentially outside of NI, so long as it's less than 30,000, I expect. Perhaps we have a chat afterwards. Yeah. I've got some availability this afternoon. We can have a chat with that individual.
Yeah, no, that's fine. I think that might be a good idea. You did break up a little bit there, Mark, so picking that up separately might be the best answer. So any more questions? Just conscious we're just coming up to the end of the of our webinar this morning. Obviously, we're very happy to take other sort of questions or get in contact with any of the presenters that you've heard. So on that note, I'd like to thank you for joining us today, and hope you found the webinar this morning informative. As we all know, tax is constantly changing. I mean, yesterday the Office for Tax Simplification issued a report on suggested changes to capital gains tax that many of us would have seen in the news. So we'll have to see what the government response is to that. And I've just seen this morning that HMRC have issued a further consultation regarding making tax digital for corporate tax, which we've been waiting for quite a while. So again, just shows how things constantly change. So we'll be providing sort of comments and thoughts on both of those in due course. We'll continue to run on top of tax events, and I suspect in the short term they will be in the virtual world. So if there's any feedback or suggested topics that you'd like covered at future events, then please let us know through the feedback request we will send out after today's event. This leaves me with nothing more to say other than to wish you well. Have a great day. Thank you for joining us and look forward to speaking to you again soon. Thank you.